Welcome to Takeaway with Sam Oches, a podcast for leaders of growing restaurant companies looking to take their businesses to the next level. In nearly 2 decades covering restaurants, I've gained access to some of this industry's most influential decision makers, and I'm letting you in on the conversations. In today's episode, you'll hear from the founder and CEO of the world's largest franchisee about what it takes to run a premier operation and why he's just inked a deal with his first emerging restaurant chain. Greg Flynn is the founder and CEO of Flynn Group, the largest franchise operator in the world with 8 brands in its portfolio doing about $5 billion in annual sales. 7 of the 8 brands in the portfolio are restaurant franchises, as Flynn Group has spent the past 25 years partnering with some of the biggest restaurant chains, including Pizza Hut, Applebee's, Panera Bread, Arby's, Wendy's, and Taco Bell. Last month, Flynn Group announced that it had entered a franchise agreement with 7 Brew, marking the first time that the organization has partnered with an emerging chain. I spoke with Greg right after they announced that 7 Brew deal to find out why it's a good fit for the Flynn Group portfolio and to get his take on the volatile marketplace and where it could go from here. In this conversation, you'll learn more about why the most important determinant of success is day-to-day operations, why American brands in international markets are like startups with less risk, and how the right promotion at the right time can change an entire brand's trajectory. If you learned something from this episode, go follow Takeaway wherever you listen to podcasts and leave some feedback. It's the best way to get that lesson to a fellow restaurant leader. Jumping now into my interview with Flynn Group founder Greg Flynn. Also, don't forget to stick around after the interview as I will share my 5 takeaways from this discussion, actionable insights that you can take with you on the go. Okay, talking with Greg Flynn of Flynn Group. Greg, thanks for sitting down with me today.
Well, Sam, thanks for having me.
Greg, very exciting news that we're going to cover, and that is this partnership that the Flynn Group has made with 7 Brew to franchise with that organization. So you've been in the franchise space really since the 90s. I think 1999, you got into the Applebee's business. And in that time between then and now, you have grown into the largest franchise operator in the world. Give me the scope of Flynn Group and what this business entails.
Sure. So right now, Flynn Group is comprised of 8 brands, 7 Brew being brand new to it. And we don't actually have any stands open yet, but I'll include that. But really the 7 are Applebee's. I'll do it chronologically. Applebee's, sure. Taco Bell, Panera, Arby's, Wendy's, Pizza Hut, and then Planet Fitness as our first and only non-restaurant brand.
Sure. So if we look at those restaurants, I think there's one thing we can all see from those restaurants, which is those are all established, mature brands. And I know that's been part of your strategy. Why are these massive systems, these massive mature brands, why were those your target to start?
Well, initially when we got into the sort of large chain restaurant business in the late 90s, I was coming from a brand new startup called World Wraps. And, it was a great concept in ways, very difficult to execute, still exists actually. But I learned from World Wraps how hard it is to be in a raw startup restaurant concept. And in the late 90s, you may recall there was a form of financing that briefly emerged. It was securitized franchise finance. And it was only available to the biggest, most mature brands. And I looked at it, I was like, why? Like, I can't get any financing for this raw startup. Why is such amazing 100% financing, non-recourse available for these mature brands? And when you talk to lenders, it's because, mature brands have a track record of steady, stable performance. And they're perceived by lenders to be a lower risk bet. And the more I studied, I realized that's probably correct. It is correct. And the return in those businesses can be very good, and they can offer a very high growth rate for you if you're growing within the system. And so I concluded it was just a better risk-adjusted bet for us. We were very young, and I really couldn't afford sort of any stumbles, right? And so we leaned into Applebee's. Applebee's in the 90s was the hottest concept in the fast casual segment, and fast casual was itself probably the hottest segment at the time. And we bought 8 Applebee's restaurants in early 99. We did a number of things to them, including, they formed the core of our whole relatively decentralized, empowering operating model. And it started going extremely well very quickly. So Flynn Group currently consists of just under 3,000 restaurants and fitness clubs located in 44 states and 3 countries, the countries being the US, Australia, and New Zealand. We operate in 7 brands currently, 6 restaurant brands, chronologically, which are Applebee's, Taco Bell, Panera, Arby's, Wendy's, and Pizza Hut. In 22, we got into our first non-restaurant brand, which is Planet Fitness. And of course, we've signed up for 7 Brew, and that'll be our 8th brand. The whole group generates around $5 billion in sales, employs about 78,000 people right now. And we are the largest, one of the largest franchise operators in each of our system. The exception really being obviously 7 Brew, where we're sort of 0 right now, and Planet Fitness, where we're still relatively new in our in our growth in the system.
So if you look at these brands in your portfolio, the restaurant brands in particular, obviously you guys are, you started with mature concepts, mature brands. These are major systems. And that was a goal. I know you've talked about like, this was what you wanted to, the direction you wanted to go in with these mature brands. Why is that?
Well, so I actually got in the restaurant business in 95 in a brand new startup concept called World Wraps. It's a wonderful concept. The food's great. It's very difficult to execute. Still exists, actually. But that taught me, and we built 14 of them between 95 and 99. We were making a go of it, but it was very, very hard. Everything about it was hard. And in the late 90s, you may recall that a form of financing emerged for available to the largest concepts only. It was securitized franchised finance. And they would loan you 100% of the cost of building or buying a restaurant, non-recourse, call it 7 or 8%. And contrast that to World Wraps or any other restaurant startup where no financing is available. And I looked just like, what do they see that I don't see? And what they saw was a relatively high level of stability and consistent performance in the largest, most mature brands. And that to them equated to lower risk. And I think they were right about that. And at that stage in the journey, I was like, wait a minute, I can borrow all the money, get into a mature brand. I can do that because they're lower risk, and yet they still offer attractive returns. Not as attractive as if you started Kava or something like that, but still attractive. And that's what we did. So we bought 8 Applebee's restaurants in 99, and we started growing from there. And I think that focus on mature brands served us very well. We were able to grow at a very high rate in each of the 6 major restaurant brands that we've entered. Because growth for us is not necessarily the same thing as growth for the brand. It can be a mature brand, but we can grow within it. And we have grown at nearly 30% compounded for, over 25 years now. So it's really worked for us.
Yeah, it's incredible. I mean, it's interesting because, obviously you're in essence playing it safe, but playing it safe led to you becoming the largest franchise operator in the world. Now, I'm curious too, because we think about, again, the scope of this business. You mentioned all those numbers. $5 billion in sales. That places you, if you were one entity, you would be a top 10 restaurant brand in America. It's remarkable, or top 15 maybe. Remarkable to think about the scale of this. And you've accomplished all this. I know, I see on your website, your goal, as you've said, is to be the premier franchise operator in the world. And so considering this, you've gotten it in terms of scale. What's the goal? What does it mean to you to be the premier franchise operator in the world?
Sure. The key word there is operator, first and foremost. We are restaurant operators. We are, let me be clear, we're not private equity investors. We're not a fund. We don't, make investments and then hire management teams and let them run. We are restaurant operators. I wake up every day and what I care about is like, how are we doing in the field? And I need to build a team, and we need to open our restaurants and deliver great products and service every day, everywhere. And that is simple to say and super, super hard to do. But our view is that the most impactful determinant of success in the restaurant business is day-to-day operations. Like we can survive a lot of, decisions around marketing campaigns or menu items or technology that weren't necessarily the most effective. But as long as we continue to execute well in the restaurants, like I think we'll survive those. And before long, all of our brands do get it right.
Mhm.
What you can't survive for long are poor operations. Like no matter how good your marketing is, like if they come to the restaurant and you give them poor experience, like they're not coming back in your restaurant's going to decline. And I've seen many investors make this mistake. They think the hard part is like buying the restaurant or whatever, and then they'll just hire someone to run it. That never works out well. Like, so if you're going to be in this gig, especially at scale, like you need to, in my opinion, understand that operations are the highest priority by far, right? But the
Yeah.
franchise model really lends itself to that. It's a divide and conquer model. So, we focus on being great operators, also developing restaurants, but first and foremost, running what we already have well. And we have our franchisors who are totally focused on menu and marketing and technology and prototype. And we are collaborative and we assist in all that. But the divide and conquer, I think, makes both of us better at what we do, and therefore the franchise brand, better at what it does. Now, there are many
Yeah.
examples of non-franchise brands that are amazing, like Kava or Chipotle or whatever.
Sure.
But I think it can succeed either way.
Yeah, absolutely. So it brings us to then this news that you've partnered with Seven Brew. So this is part of a new operating platform for Flynn Group called Flynn Growth. And the goal here, and I told you off, before we hit record, I remember you announced back at RFDC a year ago that you guys were looking in this direction. And so I guess I'm wondering, what spurred this direction to go toward more growth-oriented concepts that, using your own language, are a little bit higher risk because they're not mature. What was the impetus of wanting to go that direction?
So, as I mentioned, we've grown at a very high growth rate for almost 30 years now. And as you get bigger, that gets a little harder because proportionally, you need to, somehow generate more growth. So part of it was driven by that. We need new growth channels to be able to, reinvest the money we make in our existing business. And, we do it in our existing brands. We build as many restaurants as we can find sites. But, there's opportunity to put capital to work elsewhere too. And so if you think about Flynn's growth in chapters, chapter one was Applebee's, did nothing but that for, 12 plus years. And that focus really served us well. Chapter two was diversifying as a franchise restaurant operator domestically. And that, was successful in recomposing us to mirror the industry, becoming mostly a QSR company.
Mhm.
Chapter three is continuing to grow as fast as we can in that big center lane of domestic franchise restaurants in our existing brands, but layering on now three new growth channels. Right? So the growth channels are international, and we are now the master franchisee for Wendy's and Pizza Hut in Australia and New Zealand. It's adjacencies, and by adjacencies I mean multi-unit, consumer-facing retail services businesses that operate under a franchise model that aren't restaurants. And Planet
Mm.
Fitness is, our example of that, but it's a perfect
Yep.
example. And the third is now younger concepts. Right? It's Flynn Growth. And think of it as a platform or a channel. We've very self-consciously sort of avoided getting involved with younger brands for the reasons I've discussed. But now we have a very large,
Mhm.
stable base of of operations and a strong capital base and a strong team. And I just think it's now time for us to. We are in a position to sort of branch into this channel, and it may entail a
Mhm.
little bit more risk. It does, but it's a level that is not going to jeopardize our platform in any way. And I think you also need to parse between raw startup risk and something like Seven Brew.
Mhm.
Seven Brew wouldn't have cleared our filter for like a mature brand because it's not. It's like it's the highest growth brand in the industry right now.
Yeah.
It's crazy the growth it's experienced, and it deserves it because the brand is fantastic and the operating model is amazing and the brand leadership is as strong as I've seen. And they have 500 units.
Yeah.
And so it's not a raw startup. It is meaningfully less risk than like a raw startup with 5 units or 20 units like World
Right.
Wraps had. Yet for us, it represents, a growth concept because it's growing at this crazy high rate. And so it was the perfect first step for us into
Right.
that. It doesn't mean to say that we won't do even younger concepts. We may at some point, and we may look at things a little later in their life too. But Seven Brew right now, my view is like it's not 100% proven the way like a Taco Bell is proven with 7,000 plus
Right.
units and growing, but it is way more proven than a raw startup, and it's basically to the point of momentum like I've never seen. Like, so when I say it's risky, it's like a lot less risky than you would think.
Totally. Yeah. Yeah. It's so true. It's sort of funny to think about a 500 unit system as being emerging in any way, because they've certainly established themselves. But I'm curious too, because I mean, considering again the scale of Flynn Group here, to your point, you're not making a bet on a 5 or 10 unit brand and just seeing what happens. This is still a relatively safe bet. But what are the filters that you put a potential brand through to figure that out? Because if I think of Seven Brew, for example, it is part of what has become, I don't want to call it a trend, but this beverage drive-through movement, which is surely, as I'm sure you agree, here to stay. It's a little new, this beverage drive-through model, and it's got a lot of competitors, a lot of activity in the space. But what would be some of those filters? Because you're not going to throw in with no offense to my friends in the poke business, but I'm sure you're not like looking to put a bet on a poke business, because that might just be a niche kind of trend bubble or something like that. You're clearly looking at the longevity here, right? What are some of the filters that you're looking in?
Sure, great question. First of all, it needs to be a good complement to our existing portfolio, and not too much of a conflict with our existing
Mhm.
portfolio. And we have not been in coffee. We are not in coffee, and and that's a big category. And then when you look at Seven Brew, it's about way more than coffee. I mean, it's a very broad menu. More than 90% of the drinks sold are cold. Right? It's like a cold beverage business primarily. I think a little over a third are energy drinks, and it's a very broad menu, highly customizable, and it connects um, brilliantly with Gen Z, and maybe even Gen X, but
Mhm.
like definitely, or Gen Y. I'm mixing up my gens,
Mhm.
uh, but Gen Z, and I think and you see it broadly across the industry, as you mentioned. I mean, there are competitors to Seven Brew. Dutch is an obvious one, but there are others. And then, many brands are leaning into beverage, as, a product category in their broader menu. But that doesn't necessarily say anything about Seven Brew's prospects. Seven Brew is executing in this high growth category. Frankly, I think better than anyone. Like it's a brilliant model. Like I don't want to repeat myself, but like led by a great team with great unit economics, with a great culture. I mean, it's a very people first business. One interesting thing to
Mhm.
notice about Seven Brew is how culture forward it is. Right?
Mm.
People are going there, especially kids are going there in part for the human interaction experience, and it is sort of it's contrary to the trend toward automation and less human interaction you see going on elsewhere in the industry. And I
Mhm.
like that part of it too. And I feel like that's something that is really resonant with our Flynn culture and something we can deliver on consistently over time. So there's just so much to like about Seven Brew in particular, but I also like the category because it is probably the highest growth category right now.
I got to tell this story, which is Seven Brew opened about a mile from my house, probably 6 months ago. And I went through, and there was a young person, at the station as I was waiting for my beverage to be made. And on the glass window, there was written, it was a poll. They were taking, what was your favorite childhood channel? It was like asking, are you a Disney kid, a Nickelodeon kid, or a Cartoon Network kid?
Yeah.
And at first I'm just like, what is going on here? But what it was an icebreaker with the person there, and he and I got to talking, and I started talking about my kids and all the things I watch with my kids, but that was exactly the point of what you're saying here, which was it became an experience deeply rooted in that Seven Brew culture. Where I want to go with that though is you mentioned the Flynn Group culture. Um, how do you onboard a brand like a Seven Brew and mesh those two things, the Flynn Group culture, the Seven Brew Group culture? How do you ensure that this is sort of a seamless onboarding process?
Well, I think the first thing you do is you evaluate it up front to see if it's going to be a good match.
Mhm.
And we spent huge amounts of time studying the whole segment and then all the brands in it, and then Seven Brew in particular. And we think there's a very good natural fit to begin with. We're a very people forward organization. They're at the center of everything we do. They have to be, by the way. I mean, if your mission is to be the premier, franchise operator in the world, like it needs to be all about people, right? Because without, blah, why. So it was good fit
Mhm.
to begin with. And then second, we're building it from scratch. Now, in other brands, we've often bought existing restaurants and we've onboarded them, and we're very experienced at doing that. And sometimes it goes, smoothly, and sometimes it's got a little growing pains, but we always get there. With
Mhm.
Seven Brew, I think, because we're starting from scratch, we can really build it almost more easily to be compatible with, what is unique about the Flynn culture, given that it's already a good fit anyway. Like, I don't think it's going to be hard. But, it's a blank canvas right now. We can write our own little signature on it.
Yeah, that's got to be pretty exciting. I'm curious. Obviously, you don't have to name names of other companies you're looking at, but what are some other categories that excite you? Because again, the beverage drive-through, or just beverage innovation in general, it just, to me, and getting back to a point you made, I mean, there's really no limit to me on what is going to happen with the beverage category from here because of the demand in beverage and the fact that it's just such a massive mainstream platform. What are some of the other categories that represent this, maybe not super mature, low risk, but somewhere in that sort of mid tier that you might look at for the Flynn Growth platform?
Well, as you guessed, I'm not going to name any
Sure.
individual concepts, but I mean, there are whole segments of the industry which still offer a lot of potential. I mean, almost everything ethnic,
Mhm.
and Chipotle sort of did it in Mexican fast casual. We're obviously in Taco Bell, so that's Mexican sort of
Right.
already spoken for us. But Kava came along and is doing it for Mediterranean and doing just a phenomenal job. But I believe that format is an attractive format, and the U.S. consumer is increasingly interested in sort of interesting foreign cuisines. So I think
Mhm.
you can almost take, almost march away around the world, and I can see concepts emerging, you know, following that formula, and really getting traction. Now, again, we're not going to join them when they're 5 units, but when they get to 500, we'll talk, or even
Right.
200 or something like that. Um, and then,
Sure. Yeah.
it's a big world. So there are very interesting international opportunities. Right now, we're really focused on Australia and New Zealand. We're building a fantastic business there. By the way, I mean, here's some interesting news. We just
Yeah.
opened our second Wendy's in Australia. It was a flagship location in downtown Brisbane. And
Huh.
I don't want to jinx it, but I think we're going to set the all-time sales record ever in Wendy's for a first week sales. We already did it for the first day sales, or highest day of sales
Wow.
ever, not first. But I think we're
Wow.
going to do it, for the week. It closes tomorrow, and we'll see. But no
That's
matter how you
exciting.
slice it, it's a monstrous opening, and it's
Mhm.
so exciting. And our first unit in Surfers Paradise was a monstrous opening too. So it's super fun to like take a brand like Wendy's and sort of evolve it a little bit and introduce it to a new place. And it's almost like a startup, but it's not really a startup,
Right.
and not as risky as like a raw startup, but it still gives you some of the upside opportunity. So,
Yeah.
internationally, I think we'll have a lot of opportunity. And then there are adjacencies like Planet Fitness. Right now, we're just totally focused on Planet Fitness, but it's a broad world of consumer services businesses that operate under a franchise model. So there's a lot you can
Right.
do there.
Well, I live in Columbus, and my audience knows I have Wendy's in my veins because I'm a native Ohioan. So that brings me a lot of joy to hear that about Wendy's.
Right.
But that leads me to my next question, which is, your portfolio is fascinating for this state of things because you have kind of everything going now. Obviously, with Seven Brew, especially, you really kind of run the gamut of restaurant concepts, but you see through Applebee's what's going on in casual. You experience through Panera sort of the trends in fast casual. And then, you have a Wendy's and a Taco Bell, especially like a Taco Bell, which is sort of defies defies all norms and sort of lives on this other tier because of its connection to its guests and that sort of lifestyle vibe it's developed. And so it's fascinating because my job is to try to understand what's going on with the industry, the economy. It's really hard to get a read on things right now because, some would say that this time is, this season where we are economically would lend, the QSR space would suggest the QSR space would be blowing up, but the QSR space is struggling with traffic. Some might suggest there'd be trade down going on to really elevate fast casual, but there's a lot of data suggests fast casual could be struggling. And then you get these players like a Chili's, obviously one of your competitors, but just kind of like rewriting all of the playbooks on full service. I can't make heads or tails of it, but you've got a portfolio that you've got a kind of good grasp on this entire sector. How do you make sense of any of this as it relates to kind of where we stand with things?
Well, great question. We do have a pretty broad view on the industry and therefore on the economy. I think there's a lot going on all at the same time. I mean, a common theme everywhere is, consumers are very cautious right now. Consumer confidence is low. And look what's going on. I mean, we have wars around the world. We're coming off of hyperinflation. We have a government that is still shut down as we speak. There's just a lot to make people nervous right now.
Yep.
And so they are more value conscious than I've ever seen in my career. So all of our brands need to be super aware of that. And they all are aware of that. And then within brands and even as between restaurant segments, I think it comes down in large part to individual brand performance. They're operating under the same sort of global conditions, but some are really delivering and continue to deliver on what customers value the most, and therefore they're driving positive traffic and they're gaining share, and others are sort of missing it a little bit right now. That will probably change over time. I mean, every mature brand is only one or two promotions away from an altered outcome, right? I mean, it changes all the time. The one you didn't mention there is Arby's. Arby's steak nugget promotion is great. And you come out with the right promotion at the right time and it can completely change your trajectory. And I think that's partly what's going on is, it just happens to be that, some of our brands are really sort of connecting with what the consumer wants and needs right now. And some are doing a little less so. And that's why you have a portfolio, right? A diversified portfolio. So it all balances out to a pretty good year for us. It's not like 21 or 22, which were standout years when the tide was rising for everyone, right? This is not that year. This is a more normalized year.
Yeah. Well, it's
by the
interesting.
way,
I was just reading this morning.
You mentioned Chili's. Chili's is obviously a standout, crazy success, in the whole industry right now.
Yeah.
But the whole casual dining segment is actually having a pretty decent year, including Applebee's. I mean, you saw their last quarterly announcement. It was good, right? Very good.
Absolutely. Yeah, for sure. And that's where it's like, we talk so much about sort of the pendulum swinging. And I think what may be happening, maybe you could validate this, but I've covered this industry for over 16 years now. And that pendulum was was slower. It used to be slower, right? And it was more comprehensive, where it was like there was a period where QSR was doing very well, full service maybe not so. Then you kind of swings back over to full service doing well, QSR maybe. But maybe things are just going a lot faster because just 6 months to a year ago, so many people are writing this obituary for full service and for casual dining. Yeah. And then it was just like, oh, wait a second. No, maybe casual dining's doing okay. Is it just that the pendulum swings faster?
Okay, so I think you mentioned a year ago on stage at the RFTC or someplace, I mentioned that we were looking into growth, and here we are now.
Yeah.
But I think in that same session, I mentioned don't count casual dining out.
Yeah.
Because, the basic, bet behind casual dining is that there will always be a large market for sit-down dining, table service, and liquor. Mm-hmm. And I believe that. And some will execute well or better than that than others. But there's always going to be a large market for that. I really don't buy the idea that people are only going to want to get their food over a counter and take it away or whatever. I mean, we're selling experiences. Boy, did that turn out to be the case this year, right? Mm-hmm. And I think what happened also is, Applebee's and Chili's, we deliver exceptional value that is certainly competitive with fast casual and almost really even competitive with quick service. And consumers are figuring that out. Like you can pay almost the same amount, sitting down, getting a terrific burger and fries and a drink in an Applebee's, and you're really not paying much more at all than you are in a quick service restaurant. And Chili's in particular advertised directly to that point successfully.
Yeah.
And so that's, like I said, people are more value conscious than ever. I think enough people figured out that the value may actually be really good at casual dining. And so that, kind of swung back that way.
Yeah. Well, it seems like two things are true, which is customers increasingly are demanding value, but customers are increasingly demanding an experience. And once upon a time, maybe those two things were at odds because value was seen as a cheap price point that tended to skew fast food. But now there's more of a value perception of there's value in the great service I get in a full service experience. There's value in, even if I pay a higher average check, there's still value in what I'm getting for that dollar. So it seems like that plays right into an Applebee's hands, which is I'm going to get service. I've got alcohol that I could get if I chose to, and bang for the buck, even if I'm spending more than I would in a QSR. Maybe that's just the foreseeable future. Talking about the pendulum swinging, I don't think that sort of value plus experience or perception of value doesn't seem like that's going to go away anytime soon.
Yeah, I agree with you. I don't think it's going to. And Seven Brew, like, plays so perfectly into that trend because they're selling great drinks at a good price in a very fast format, but with this human experience. Like, so it's sort of capturing all aspects of, sort of current trends and good for them. That's why we're there.
Absolutely. All right, Greg, last question for you. What's next? We talked about Flynn growth and what this represents, and I know you can't get into, who else you're looking at, but is this something that you're planning on really ramping up quickly, or will you be measured and more calculated in some of these other brands that you choose to partner with?
I think we'll definitely be measured and more calculated. We've made a major commitment to Seven Brew, and we need to make sure we fulfill that commitment. And so that's going to be our focus for the indefinite future until we are sure we're 100% on track for that. And we have other objectives with the other segments of our business, and we're going to, for instance, in Australia, we're really building up a big business there. We've got development going on all of our domestic restaurant brands, and so we always have, and we will continue to look at new opportunities, but we won't do them unless and until we feel like we're really well positioned elsewhere to take on something new. And, we do feel like that now. That's why we're able to layer on Seven Brew. We wouldn't do it if we felt like we were sort of missing somewhere else. But it's additive and not subtractive. It's not a zero sum sort of, take from Peter to pay Paul. We need to be in a position to do it all well. Right.
Yeah. Well, it's exciting to watch, and good luck on the Seven Brew partnership. Really exciting to see where that goes. Greg Flynn of Flynn Group, thanks for joining me today.
Thanks a lot, Sam. Really appreciate it. Take care.
That was my interview with Flynn Group founder Greg Flynn. So what should you learn from this interview? Here are my 5 takeaways. My first takeaway is that the most impactful determinant of success is day-to-day operations. That's a direct quote from Greg, and it may seem like a very obvious thing to say, but it is an important reminder in this day and age where you have, for example, investors out there scooping up a bunch of brands and thinking, if I just build a portfolio of all these brands and they can handle their own thing, they'll be fine. I'll do great. The fact of the matter is, you have to run a tight ship. You have to run great operations. Greg is quick to make this distinction between franchisees and investors, probably because he may come across as an investor because of his scale. Doing $5 billion in annual sales across 8 companies, it looks like maybe a private equity group or something. But the fact of the matter is that Flynn Group, they're operators. This is a franchise organization. And as I'll talk about here in a second, Greg pointed out, they are people first. They put great people into their operation as great franchisees to run great restaurants. But it all comes down to that day-to-day operation. Greg made the point that the nice thing about franchising and the great thing about that model is that you can divide and conquer. You can ensure that you're running a great operation on the ground in the restaurants. And at the end of the day, it seems so simple, but if the customer comes into the restaurant and has a bad experience, they're not coming back. So if you don't run great day-to-day operations, you're not running a great franchise. This is, again, something that seems very simple and very basic, but it is easy to sort of lose the forest for the trees here. You might, start to look at the big picture of, oh, wow, look at this $5 billion organization. But Greg says, look, if they don't run great operations in every single restaurant in their portfolio, that $5 billion isn't going to happen. So that's the most important factor for your success. It's got to start with that day-to-day operations. My second takeaway is that to be a premier franchise operator, you must be people first. I just mentioned it, but it bears repeating. Greg talked about it, at length in this interview about culture and why Flynn Group has its own culture. They have 78,000 employees across this organization, and they're very, very intent upon building a good culture within those 78,000 employees. And they also have to dovetail that culture within the brands they partner with. Culture is a factor, as he mentioned later on, in what brands they partner with, because they have to partner with brands that are also intent about building great culture, and then making sure those two cultures between Flynn Group and the brands they partner with can work together and build something special. The reason for this, again, going back to this idea of franchising as dividing and conquering, you have to have great people running your great restaurants, full stop. And to have great people, yes, you can go hire great people, but you also need to retain them and develop them and invest in them and ensure that you're getting the most out of them. Your culture can do that for you. So if you want to be a premier operator, franchise or not, start with your day-to-day operations, as I said, but the big piece to that that you have to be always thinking about is your people. What people are running these operations, and how do I make sure that those people are as good as they can be? My third takeaway is that American brands in international markets are like startups with less risk. I wanted to point this out because, Flynn Group is moving internationally now. They have they have the franchise rights in Australia and New Zealand, for example, for Wendy's. They're building Wendy's in Australia as we speak. And Greg sees a ton of potential in international markets. And I especially wanted to flag this because I feel like we are talking more and more lately about international markets, because a lot of American brands are seeing opportunity overseas as the opportunity here in the States dries up, or is at least just sort of stagnant right now. And I liked this thing that Greg said about international markets, where he says it's like a startup, because the example he used was Wendy's opening in Brisbane, and it was looking like it was going to set all kinds of company records. Because when you go into a market for the first time, even if you're a major established chain here in the States, you could be completely new to that market, or maybe they've heard all about you because you are a major chain here, but they've never had the opportunity to try your food and check out the brand. And you're going to get a massive. You're going to probably find massive success in those international markets. And so that's why he says it's like a startup. You get all these advantages of being the startup, the exciting brand, exciting menu, the newness of it, but you have that less risk because you are already an established global chain. That it's safe to say you're probably going to do fine in those new markets. So I want to flag this, especially for those of you who are looking at international markets as an opportunity for your own brand. I wouldn't say jump into that anytime soon if you haven't already built a solid foundation here in the US. But if you have built that foundation, if you're looking for new opportunities for growth and you've run out of options here domestically, international markets could be a great option for you. And you could find all of that upside, as Greg said, of a startup where it's splashy, it's fun, it's exciting. You find a completely new customer base over in that international market. Of course, it's not without a lot of hard work. It's not without some struggles. But if you play your cards right, those international markets can really give you that advantage of being like that fun new startup, driving lots of excitement with consumers. My fourth takeaway is that the right promotion at the right time can change an entire brand's trajectory. I think this is something everybody needs to remember right now, because we get really caught up in narratives going on out there in the restaurant industry about X brand doing very well or Y brand doing very poorly, or this brand was doing great and now it's not. What's going on? Is something wrong? A fact of the matter is, the pendulum is constantly swinging, especially with the major national chains. They have good times and they have bad times. And Greg said this, that you're really one or two promotions away from something completely shifting in the other direction, particularly for these bigger, more mature brands. And, a great example of that, and we talked a little bit about Chili's, which is one of his competitors. Greg is really invested in the Applebee's business, but he has this admiration for Chili's, as the rest of us do, because of the way it has used some promotions to capture America's attention and really drive incredible business to their restaurants. And I'm not saying, again, that this is easy. You can snap your fingers and boom, you're back on track. But Greg is trying to share perspective here on what it takes, which is to say you might have a promotion up your sleeve that equally gets the attention of your consumers, equally drives excitement, and can really jumpstart momentum in the right direction. And so, again, as we go back to some of these narratives on struggling brands or, who's up and who's down, remember that it is that constant pendulum swing, and a brand now that you might have counted out could be a promotion or two away from being that next Chili's or another brand, setting its own story for exciting things. So this is fascinating to me, certainly in media, as we watch this very, very intently on what's going on in the restaurant industry, what's working and what's not working. Get that perspective that, a lot of chains could be right around the corner from massive success. You just have to be patient. Certainly if you're a franchisee or if you're running one of those restaurants, be patient because you could have one of those promos up your sleeve too. My fifth and final takeaway is that the value offered by full service brands is resonating with consumers. Going back to that Chili's example, but also Applebee's. Within the Flynn Group portfolio, you have Applebee's. Greg has a front row seat to the success of this brand, which has really proven to have started to turn things around. It had a couple quarters where it was down. Its most recent quarter, it's got some really encouraging results. Applebee's could be drafting off that same success as Chili's, Texas Roadhouse, and some other casual dining chains that seem to have really resonated with consumers, particularly around, again, value. Fast food, fast casual, we've seen the data suggests that the traffic and sales for those categories really slowing and is expected to slow some more in the coming months. Customers, they want a special experience. They, yes, want a cheap price point, but they show over and over again that right now they're looking for great experiences, and full service casual dining brands are offering that. Greg is really optimistic about the category. I am too, frankly. We're seeing a lot of success out there in that category in how it can provide value in the experience, but also really compete at that price point as well. So do not count that category out. Those are all my takeaways for today. I hope you enjoyed this episode. Please remember to subscribe to Takeaway wherever you listen to podcasts and leave your feedback. You can also email me at sam.oches@informa.com. Thanks again and talk to you next week.